All right, guys. So right now we are talking about DSCR loans, and we kind of spoke about this earlier in one of the terms. But this loan type is DSCR, debt service coverage ratio, and what that means is essentially a DSCR loan is a portfolio-based loan, or it's an asset-based loan based on the asset that you're purchasing. It's similar to really a sort of like a commercial loan, and it doesn't require a lot of like income or a lot of like really tax returns in order to qualify you. The main thing that they do check is your credit. So with that, essentially like it's a great way to qualify, especially if you don't have like if you're self-employed and maybe you you don't want to show like all your tax returns and all of your business, and you don't want to show like too much of your personal history. It's a great way to qualify. Now, interest rates are generally going to be the highest for this type of loan because it is sort of a commercial loan product, and it recently just came over to the residential side, so you can purchase residential property using a DSCR loan. Now, the way this works is it uses the assets income to qualify you. So if you're looking at that multifamily property, that 4 unit, what you could do is say, okay, well, this income from this covers the mortgage and then some, and essentially you would qualify for that, assuming that your credit's good. And some of them still require some sort of like bank statements and whatnot. Usually they're generally identifying if you have the assets in order to qualify, because it does require 20 to 25% down payment, and that's a minimum, so it doesn't even go below 20%. So the cool thing about DSCR loans is like you can have multiple properties out at the same time. However, you do need that 20% down every single time you do a DSCR loan. With a DSCR loan, you can also do what's called a cash out refinance, just similar to all the other loans that we've discussed, but really there's no serious seasoning period, and a seasoning period is essentially how long do you need to wait in order to take out another loan against that property. Especially when we're talking about the BRRRR strategy, this is going to be really handy in doing the cash out refinance, especially when you're using the income to qualify you on that property. It's a great loan product, and again, it's called DSCR, debt service coverage ratio, and it's great for investors like you so that you can build your portfolio faster without too much infiltration in your personal finances, because I know how we like to write things off, and that's really what it helps us with, is being able to write things off and still be able to purchase properties and qualify. So DSCR, definitely talk to the lender about it and see where they're at, and as long as you qualify, it's a great option. All right, guys, I'll see you on the next one. Take care.